Hello, everyone, and welcome to ACECRT's September webinar, where we'll be discussing how to invest wisely. We appreciate all of you taking the time to join us today. We have just a few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. And at the end, we will take some time to go through these. And now I'd like to introduce our guest speaker of Invesco, Tracy Fielder. Tracy is a product management director for Invesco. He works with Invesco's U.S. value investment teams and client portfolio managers to develop sales, marketing programs, positioning Invesco's product line across all global distribution channels. Mr. Fielder entered the financial industry in 1993 as a marketing coordinator. He earned an MBA from Houston Baptist University and a BBA cum laude with a concentration in finance from the University of Houston. He currently holds his Series 6 and 63 registration. Thank you so much for joining us today, Tracy, and now I'll turn it over to you.
Well, thank you, Tori, and thank you for all of you folks for dialing in, and appreciate it. I hope your time is well spent today. I'm going to go ahead and move forward to the first slide here, and this is going to talk a little bit about what are we rethinking, and we're going to talk about what we mean by rethinking risk. If you notice the image on here, I think that most, if not all of you, are familiar with this image. It's probably one of the most famous sculptures in all of art history, and it's of course the Thinker, and it was created by the famous French sculptor Rodin. And as you can clearly see, that the man is really in sober meditation, and he's apparently battling with some type of internal struggle. Well, one fact that you may not be aware of is that Rodin intended the sculpture to represent the great Italian poet Dante Alighieri. Now, Dante, of course, wrote the 13th century poem, The Divine Comedy. And this story basically tells of a man's journey from hell to purgatory to heaven. Well, Rodin was asked by the Museum of Decorative Arts in Paris to create this grand entryway. Imagine this large wooden doorway for the museum. And Rodin decided to display a scene from Dante's novel, which is the first chapter called The Inferno, or Dante's Inferno. And so imagine carving this scene, this huge scene on the entryway door of Inferno, or hell. And then he basically took a miniature version of the Thinker and he set it on top of the door, overlooking the scene. Now, he did this for two reasons. He did it first to show that Dante was reflecting on his own work, but more importantly and secondarily, he showed that Dante was contemplating the fate of mankind below. Now, similar to today, I think a lot of us are reflecting upon our experiences in the market. And I would suspect, given at least my experiences, that some of us have at least been in what I would consider an investor inferno. And I hope, at least today, with the markets recovering, through, and generally speaking, through the last 6 years, at least the stock market has, we've at least elevated to the purgatory level. So today's presentation, I'm hoping to provide you some insight to really prevent you from going back to the inferno level. And that's really the point of this. Invesco, and the group I represent, has really been thinking about you and kind of your journey in investing in the role that we play in it. And so at Invesco, we've been battling with our own internal struggle. And that struggle has to do with the disconnect between the expectations that we set as an industry, the investments industry and the financial industry, versus a reality that we've seen over the last decade. And we think that you can trace that root cause of this disconnect directly back to the bull market of the equity bull market, of the 80s and 90s. And during that time period, a lot of myths and mantras were created by the sales and marketing departments of the investment industry to what's become considered conventional wisdom. Now, you're probably thinking, what do we mean by myths and mantras? And so these are things I'm sure you've heard. It's things like it's not a loss until you sell, or it's a loss on paper until you sell, or it's not market timing, but it's time in the market. And then a couple that we're going to actually address today are don't miss the market's 10 best days. Does that sound familiar? And really an overarching piece of conventional wisdom, if you will, is invest in equities for the long run. And really the idea here is that these mantras and myths have become so iconic and prolific that they're rarely, if ever, openly questioned. And that's until we come up with this program. So in response to this, Invesco really kind of set our sights on becoming a leader in a philosophy that we call intentional investing. Now, intentional investing has three core tenets. The first is think carefully before you invest. The second is plan thoughtfully before you invest. And the third is act intentionally or deliberately when you invest. And the Rethinking Risk program is really just a part of that overall philosophy. And as you would imagine, in contrast to intentional investing, is basically accidental investing. And accidental investing is nothing more than negative unintended consequences, which are oftentimes a result of following this conventional wisdom that we're going to go through today. So one thing I want to move to here is let's go through some myths and truths that we found through our research in the Rethinking Risk program. And we're going to do a little myth busting here. If you've seen the cable show, network show, Mythbusters, that's kind of what we're going to do today. And we'll start with the first myth, is that a lot of investors think that their portfolio is going to benefit or be in better shape than if it has more positive years than negative years. But the truth is the magnitude of that gains counts a lot more than their frequency. And we're going to talk about why the industry and how the industry overemphasizes this concept of frequency. Second truth is, or myth, is missing the market's best days is the worst thing it could do. But the market's worst day, the truth of it is, are just as important as its best days. And I'm going to explain to you why these worst days are even important or even more important than the best days. And then we're going to look at how this kind of whole prolific sales idea is based on a false premise. The third myth is that people think that there's a secret to getting rich by investing in some kind of new unheard of investment and get there first before everybody and get rich quick. But when you do the math, you look at the savings and the contribution rates really form the foundation of a portfolio's value. That's the secret to building wealth. And I'll show you some easy to understand examples of how that works. The fourth myth is that a lot of clients and investors think that they have time to prepare for events like a recession or inflation or even a bull market in equities. And they often try to forecast these events based on the most recent experiences of the market, whether they're good or bad. And oftentimes they're incorrect. Well, the truth is prudent risk management means always being prepared for a variety of market environments. And I'm going to basically talk about this in the construct and the backdrop of the insurance industry, which is grounded in risk management. And finally, people think a lot of times, and you hear it often, is I'm diversified. I own different kinds of stocks. I have small company stocks. I have large company stocks. I own growth stocks or value stocks, and I own international and emerging markets, and I have U.S. What's important to have those different types of stocks, but that's one part of your portfolio, the stock portion of your portfolio. True diversification is based on sources of risks, not on sources of returns. And I'll talk to you what I mean by those sources of risks, and then show you a portfolio construction strategy that helps you kind of shift the risk across market cycles. So that being said, let's go ahead and skip to our first truth, and that's the magnitude of gains and losses counts more than the frequency. And this really means that the market, or rather your portfolio, should be scored more like golf than tennis. Now look at the first set of statistics here. The market is up the majority of the time. And we can see since 1926 there were 89 years, and of those 65 were positive and 24 were negative. Now many investors see this kind of statistic and they think that their portfolio is going to benefit by being more positive than negative, but that's not really the case. And so let's take a look at the middle set of numbers, the scoring in the 2000s, winner or loser. And this is basically the calendar years of the S&P 500. Let's take a look at that to see why that's not the case. The bottom left of your screen is match play score. Now, this is how a tennis player would look through it. It looked through the eyes of a tennis player, and I'm not a tennis player. I'm not going to pretend to be, but I'll keep this simple for my own sake. But a tennis match or game is won by the person who wins the most sets. And it doesn't matter if a set's won by a single point or if it's by several points. The one who wins the most sets wins the match. So a match play score shows 6 up years and 4 down years. So to the eyes of a tennis player, that's a successful decade. Looking at frequency. Now, a golfer has a different view. We know that a golf game isn't scored by how many holes you win, unfortunately. It's scored by the stroke count, total stroke count. So if you blow a hole or two on the back nine, you completely blow a golf game. And so investors see the true score through the eyes of the golfer. The total cumulative return for the S&P 500 for that past decade was negative 9.1%. Now, negative 9.1% is really a lot when you think about that over an entire decade. Not only have you missed out on the positive returns that you should have received in the stock market, or could have received in the stock market rather, you actually lost money over that time period. And so this is something that we're trying to emphasize, is that many times that the industry overemphasizes the concept of frequency. And the truth of it is that's important when you're looking at managers against their benchmarks or peer group. But when you understand that the magnitude of the gains and losses counts much more than the frequency, you can see the importance of risk management and protecting against severe losses. And so back to the golf example, a good golfer understands the importance of sound course management, knows the risk-reward trade-off of each shot. So our point is why overstate frequency when really you meet or not meet is important, your financial goal, with the magnitude of your returns. In other words, ultimately, you can't execute a financial goal by cashing in a batting average. Let's move on to the second truth. Now, second truth has to do with conventional wisdom tells us that investors should stay invested over time, avoid market timing strategies, which we completely agree with. We'll talk about that. So they don't miss out on the market's top performing days, the best days. And investors are warned that if they miss the 10 best days, that their portfolio value is going to suffer because of that. But the problem with that is that it only emphasizes the positive half of the story, what happens if you miss the market's best days. But it completely ignores the other half of the story, what happens if you miss the worst days. So let me walk you through this example, and we'll see how that works. The market's worst days are just as important as its best, and we're about to see why. So if you took $1 invested in the S&P 500 from 1928 to 2014, the total cumulative return basically grew to $116 and change. Best days, worst days, all days in between. Now, if you missed the 10 best days, the best performing days during that time period, your dollar would have only grown to $38.67. That's where the warning comes from. Don't miss those 10 best days. But let's look at what happens when you miss the 10 worst. You can clearly see here when you miss the 10 worst days, that dollar grows to $365 and change, well over 3 times the original invested amount. What does that mean? Well, what this means is that losses have a hugely disproportionate or an exponential impact to our returns versus gains. And so we can clearly see here how important it is to protect ourselves against those losses, because look at what it does to when you miss out on those and how it affects your returns. Now, if you miss the 10 best and the 10 worst, you basically kind of cut out some volatility of the markets. You kind of cut off the peaks and the troughs, and you get a little bit better return. So reduced volatility obviously helps. Ultimately, we wouldn't want to invest in cash. As you can clearly see here, you don't even get a $20 bill after that long time period. So let me move over to the second slide of this truth and talk about why the 10 best and 10 worst days, this whole 10 best days ideas and not missing it sales idea, is really kind of built on a false premise. If you take the 10 best and 10 worst days, put them on this timeline like we did here, you can clearly see that the best and the worst days fell in such close proximity to each other that it's nearly impossible, pretty much is impossible, just to miss those 10 best days without missing the worst as well. And not surprisingly, the worst days fell during secular bear markets, if you look around 1929, 31, 2008, but at the same time, look above. The best days did the same. And so now that we've established it's really impossible just to miss the 10 best days, this whole iconic sales idea that the industry's come up with can be thrown out the window. It doesn't make any sense, especially now that we've established that losses really have that disproportionate or the exponential impact to our returns versus gains. It's the old saying, if you lose 50%, it requires you 100% return just to get back to even. And so in this exercise, what we're trying to really get you to focus on is that it's important to participate on the upside. Surely we want to participate when the stock market's up. That's the good times. We all want to be there. But at the same time, we have to protect ourselves on the downside, because ultimately what we want to do is meet our financial goals in the best days, the worst days, and all the days in between. And so the end goal is to meet financial objectives, not simply to be in and out of the markets on certain days. So the point of this is stay invested, but make intentional choices so that you can participate on the upside and in those good days, the best days. But more importantly, as we just saw here, is to protect ourselves on the downside. And so what this means to you as an investor, your first priority when you're sitting down with a financial planner or yourself or going through your own financial plan is your first priority should be to minimize risk and not to chase maximum returns, because that has the most impact on the downside. The 10 best days and 10 worst days, as you can clearly see here, just kind of easier to see the picture, but we put it in the timeline so you could see where they fell in conjunction with each other. Let me go ahead and move over to this other slide, because I think this is probably one, based on time's sake, I want to make sure we get to this one. This is, we actually have an individual piece that can be found on Invesco's website, and it's called Playing Defense Early On in Retirement, and it's really the importance of playing defense early on in retirement. And what this has to do is the issue of path dependency. Now, path dependency is just a fancy way of talking about compounding gains and losses. Well, that becomes even a lot more important when you're seeking to produce an income stream from a portfolio during retirement to fund living expenses. So let me translate kind of how this actually impacts a financial plan during retirement. And so in this example, we have $1 million portfolio, which you're making a 5% withdrawal, adjusted for 3% annually for effects of inflation. And for this scenario, let's make these two retirees. Retiree A is kind of the lighter yellow line, and retiree B is kind of the orange line. And for each retiree, we show two sequences of returns using the exact same annual returns, but here's the key: in exact opposite order of each other. Now, both series of returns have a 9.45 annualized rate of return. Just because they're reversed average-wise, they're still the same 9.45%. Now, let me walk you through this and what this means in the sequences of returns and how you get these averages. Retiree A, the light yellow line, invests from 1990 to 2010. And you can see here, by going through the 90s, that was a tech and telecom boom, did very well, and also the tech and telecom bubble burst in the early 2000s, and they lost some money. Then they had the recovery back into the great financial crisis, late 07 through early 09, and we see here they lost money again, but then they're back up to almost $3 million. They actually did okay. These are the clients that are actually saying, hey, you know what, I can invest in 100% stocks. I weather the stock market, I'm doing well. You know, I'm average this amount of return, I'm okay. Let's look at the poor investor or poor retiree B. They get the reverse order of returns. They're investing, and that's the dark orange line at the bottom, investing from 2010 to 1990. And we know what happened in 2009, 2008, 2007, we had the great financial crisis, because they took a hit early on, and then again back in the early 2000s, going backwards to 1990, they eventually ended up with about half of the money they invested. Now, this client actually has two issues, if you think about it. The first is the obvious. They lost 50% of what they invested in. That's bad enough. The second is actually more impactful. They have the psychological impact of losing half of what they've invested. And so this is the kind of clients that I see time and again that are sitting on the sidelines in cash that got hurt in the 08 and 09 downturn of the markets because they've been afraid to get back in the markets and not knowing when to get back in. These are the kind of things that we're trying to protect from. And so the point of this is although the stock market may have an X amount percent, 8 or 9 or 10% average annual returns, although that's come down quite a bit since August when we've sold off some. But the point is, when you're taking off money from your account during retirement, you have to play defense early on, because we don't know how you're going to receive those average returns. That's one thing nobody can tell. And when you take a hit early on, you can clearly see here, that'll impact your portfolio greatly. And ultimately, what we want to do is protect ourselves from the severe losses while understanding we still need to make a reasonable upside to participate in retirement. Now, moving on to the third truth, I get this a lot. I'm not even a financial advisor. I work more of a strategist, and I'm in product management, and I work with our investment teams. But I don't actually advise people on what to do with their money. But yet my friends know I'm in the industry, and they'll ask me, Tracy, what can I invest in? Is it China? Is it India? Right now, gold's cheap. Oil's cheap. Gold is relatively cheap to where it was high. What do you invest in to make all this money? Because they read about getting rich quick. You can buy XYZ stock and it goes up 300% or 600%, and people make a lot of money on it. But really, if you look at you do the math and time and again, it's the contributions to your retirement account or contributions and savings rate to your savings, your nest egg, that really form the foundation of your portfolio's value. And so in this case, let's look at a household income to show you how this works. Of $100,000, 10-year time horizon, and they invest monthly, and they have 3 different market environments. On the left, we have a 0% market. We'll call that the bear market. 6% in the middle would be the moderate market, and 12% would be a bull market in equities. So starting at the left, we can see 100% of contributions and 0 would certainly be 100%. That would be based on contributions. That's easy enough math. Even after 6% over 10 years, that's a pretty decent rate of return. The vast majority of your wealth is still built based on contributions. Even after a 12% compounded rate over a 10-year time horizon in the market, the majority of your contributions on the right are still made from investing made from your contributions. And so the point here is we're going to get to is that I think many times people look at this and say, well, we're missing a longer term time horizon. I'm a long term investor. Well, we actually added this here just to kind of see what that looks like. And so we had the same $100,000 income household, but a 20-year time horizon, same market scenarios. The left, we have a 0% market. We can clearly see the full amount is all contributions. 6% compounded over 20 years, still majority by contributions. Here's where they get you here. Only after a 20-year time horizon, investing at a 12% compounded rate of return, does a vast majority of your portfolio or your nest egg comprise of market returns. Now, think about that for a minute. What happened? What market did we have where we had a 20-year time period that averaged 12%? That was the bull market of the 80s and 90s, right? And in that time period, people made lots of money in stocks, and that's what you saw. And people got that mindset that those kind of markets are normal, and many times are hoping for them to come back just in time for the retirement. Our point here is by studying market history, we know that just it takes 1 or 2 market corrections, big ones, to get the 76 to 24 down to about a 50-50 mix. And by studying market history, which we do a lot of in Rethinking Risk, we know that every generation of investors experienced at least 150% correction, or bear market, if you will, from peak to trough, and multiple downturns of 20 to 30%. So this 76 to 24% kind of thing is really an anomaly that we saw back in the 80s and 90s. If we want to get to really to where the rubber meets the road, and the best, I think, the way to do this is focus on kind of some things you can control, I think this is the best slide. In this case, we actually have 2 different households. They both have $100,000 income. They both have 10-year time horizons. The left household saved 10% a year, but they're very, very good investors. They're the excellent investor, in fact. They made 12% compounded rate over 10-year time horizon, and they've almost doubled their original $100,000 investment, $10,000 a year for 10 years, and almost doubled it to $193,000 in change. That's the family that's bragging at the Super Bowl party, say. Well, the one on the right is another household, say down the street. They saved 20%, but they didn't know what to do with their money. They heard they could lose a lot of money in the stock market. They saw people lose quite a bit back in 08 and 09, and they heard about Ponzi schemes, so they didn't want anything to do with it, so they stuck their money in their mattress, or the equivalent nowadays, say your checking account. They made 0%. But because they invested or saved, 20% versus the 10%, they bested the excellent investor by over $6,000. The idea behind this is not to say to invest all your money in cash or put it in a checking account, or certainly not your mattress. But it's 2 things that you can control. One of the big things that we focus on Rethinking Risk is focusing on things you control. We can't control the markets. We can't control timing. We don't know how long economic and market cycles last. But 2 things that in this instance we can control. In this case, we can see we can control the savings rate, at least to a degree. The more you save, the more conservative of an allocation you can have in your portfolio, and that means you can control your asset allocation. So control the amount you save. The more you save, that's your growth engine. You can control your asset allocation to have a more conservative portfolio. And this simply means that you're less aligned with the market and not subject to the whims of the market more than you are your savings rate. And so ultimately here, what we're talking about is when you're sitting down with your financial plans and your goals, we don't want to, a conservative portfolio does not mean a 0% rate. Okay, we don't want you putting your money in your mattress or in a checking account, because the effects of inflation would erode your purchasing power. There's all kinds of different things. In fact, we have a piece called Rethinking Risk piece called Cash: The Risk of Playing It Too Safe. That is too safe. But I think that you can, people that feel uncomfortable with taking the full brunt of the market, because we've seen it here lately, like in the end of August, it can get kind of scary out there, especially when you see a 12% downturn in a matter of a few weeks. And so again, when you're sitting down with your financial plan, what we want to do is set to ourselves realistic saving expectations and not unrealistic market assumptions. And before I move on to here, I just wanted to make a point. If you folks have not read The Millionaire Next Door by Thomas Stanley, I highly suggest it. And the bottom line is Stanley's research showed that the typical millionaire was really a super saver, the guy on the right or the gal here on the right, the family on the right, versus the excellent investor, which is on the left. And so that's the people that really sock away, 35 to 60% of their you may be able to do something close to that. So now let's get away from numbers for a little bit and let's start looking at kind of portfolio construction and seeing how we can kind of prepare ourselves. And so if you remember earlier on in the presentation, I said that many investors try to prepare for events like a recession or inflation, and I mentioned a bull market in stocks, and they think that they can do that and accurately do that based on the most recent experiences. It's investor psychology and behavior. They do that based on their most recent experience, whether that's really good or been really bad. The problem with these events, some of these events, like a recession, for instance, could have a catastrophic impact on your portfolio if an investor is not prepared. So consider these quotes about hurricanes, okay? And if you lived on the coast, I actually do live on the coast. I live near the coast. I'm in Houston. And there's no way in heck I would read these in the newspaper, these quotes, and I wouldn't call my insurance agent and cancel my flood and wind insurance, damage insurance, just because there's a low probability of a hurricane. I'm not going to take my insurance off because of the impact of one such so high that I wouldn't want to do that. I wouldn't leave myself unprotected. And I can tell you, living in Houston, it'll be completely clear on the radar, and within 24 hours we have a tropical storm or a hurricane barreling down on us, and we're headed to the hills. But what if I really told you that these quotes were actually from the financial media back in late 2006 and early 2007 with one important difference? If you replace the word hurricane with the word recession. And in that environment, a lot of investors left their financial houses unprotected. What they did is, to think about it, they avoided asset classes like long-term government bonds or cash that have historically held up during recessions. And instead, they position their portfolios for sustained economic growth through mainly stocks, but other equity-like investments like REITs, real estate investment trust, or high-yield bonds, or anything that highly correlated with equities. And what happened was their portfolio took a severe and consequential hit when the economy slipped into a recession back in late 07, all the way through 08 and early 09. And the markets plunged, and all of those equity-like investments highly correlated together, and boom, received bad losses within their portfolios. If you think about it, the problem is that many investors disconnected the probability of a recession from the impact of one. And so for those of you familiar with the insurance industry, I worked for one for 10 years before I started working in Invesco at a variable annuity insurance agency. And you know that actuaries or insurance companies really like to insure a high magnitude event, even if it has an extremely low probability of it occurring. In fact, you can see that. I read an article during the March Madness where a website takes out $1 million insurance claim because they claim if somebody gets the brackets right, then on their website, for the college games during the playoffs, they get all the brackets right, they win $1 million. And so they basically insure, this website insures against in case they have to pay that out. The probability of getting all the brackets correct as you know, that if anybody's played it, are one in hundreds of millions. So it's very, very low probability, but they insure it anyway, regardless. The point here is that many investors take an all-in or all-out approach on their investing. They're all in stocks or they're all out of stocks. We're all in bonds or fixed income, or we're all out of fixed income. It's all in or all out kind of perspective. But prudent risk management means being prepared for a variety of economic possibilities, and you can't do that if you're all in or all out of a certain way. And so the message here is not to leave your financial houses unprotected. So that leaves us with the question, how do we prepare our portfolios for various economic environments? And that brings us to our final truth, is what is true diversification based on sources of risk, not on sources of returns. Now, if you folks remember earlier on at the intro, I was talking about the financial, there's a financial mantra that runs throughout our industry, and it says invest for equities for the long run. And if you think about it, in looking at this chart, this is kind of where you kind of come up with that mentality. This is what is called, it used to be called the Ibbotson chart, now it's called the Morningstar chart, and it shows the long time growth from 1925 to 2014 of stocks versus bonds versus cash, which is treasuries in this case, and inflation over time, very long period of time. And as you can clearly see, large cap stocks by the orange line at the very top with the $5,304, which is $1 of growth over that time period. Equities outperformed over that whole length of period of time. And we know that to be the case because of something called the equity risk premium. Investors should be compensated for the risk they're taking in equities. But we all know this, and everybody on this phone, you don't have to be a financial advisor to understand this, that although equities outperform over this long period of time, they don't outperform all the time. And we know that. We saw that in late August. We saw it yesterday in the stock market. But we also know by studying market history that these periods of underperformance can last for significant periods of time. And I'm about to show you that. Now, and what this means for you and for myself is the implication of these significant periods of underperformance of equities can have a significant impact when you look at it through the context of your individual timeline and your own financial plan and your goal of reaching retirement. So instead of taking $1 and anchoring it to each of the major asset classes and allowing it to compound kind of over to infinity like the prior chart, what we did here is we took each of the major asset classes, stocks, bonds, commodities in this case, cash, and we put them in three different economic environments: deflation, low inflationary growth, which is a bull market in equities, and inflation. And so I'll walk you through this, what we call building a better block chart, which is kind of showing how this works in each of these environments. 1929 to 1941 was deflation or a huge recession. It was the Great Depression. And of course, during that time period, bonds outperformed. The very opposite end on the right, 2000 to 2014, 15 years was deflation-like. And that's because the Fed, as we all know, have kept rates down artificially low for many years now. And so that's been a tailwind for bonds because low yields equal higher prices when it comes to bonds, because bonds and yields or interest rates are inverse of each other. Now, if we move over to the middle, 1966 to 1981, the 16-year time period of inflation, we see inflation at 7%, outpaced T-bills, which are cash, 6.83%, which outpaced stocks at 5.95% for that 16-year time period. Now, right to the right of that is a 9-year time period, which is also an inflationary period. And we carved out the 73 to 81 time period because commodities, the index for commodities, the GSCI index, was incepted in 1973. And in that 9-year time period, that we can see here that commodities were the only major asset class that outpaced consumer prices, which are inflation, which also outpaced cash and stocks. Okay? I want to make that point because a lot of times you may read in Investing 101 that stocks are a good hedge against inflation. Here's the trick. It's partially true, okay? But stocks struggle, or in this case, get pounded sometimes when inflation is making its way through the system. And until that inflation is expected, the stocks will tend to do better on the back end of that time period. And that's exactly what happened in the 1973-1974 bear market for equities, which was actually the worst bear market before the 08-09 financial crisis we had, other than the Great Depression. So it was like our third worst bear market in history, and it was the second worst until we had 08-09. So just something to keep in mind. And then we bookend inflation from 1942 to 65, bull market in equities, and 82 to 99, the one kind of near and dear to our hearts, the one I grew up in and investing in the 90s anyway, tech and telecom bubble, 18 years. And that's where stocks outperformed, okay? But here's the key. That's 42 years out of 86 years represented on this entire length of this long time period and showing these major economic environments. Therefore, that says that the other more than half the time, stocks did not outperform. That's kind of my point is do we always want to invest for equities for the long run perspective when we're making allocation decisions in our portfolios? Because what happens then is that we're only going to be successful with our financial goals in one environment, and that's going to be a bull market in equities. So, moving to the next slide, is that now we see what we mean by true diversification based on sources of risk. The sources of risks are the shifting economic environments, okay? And it would make sense that true diversification would mean that a diversified portfolio should include a mix of asset classes that are going to perform differently in various economic and market environments. And here's the key. Avoiding having a single asset class, like stocks, dominate the outcome of your portfolio because you're only going to be successful in one of those environments. And we don't know how long those environments are, when they're coming, and how long they're going to be here. So in the case of this, we show three major economic environments like we did on the chart before. In each of these environments, we're going to look at some asset classes that you can consider when preparing your portfolio for these environments. And so in inflation, we already talked about commodities. Direct real estate. We have a whole piece on correlations on REITs, which are real estate investment trusts, that would be on to the right under low inflationary growth because they're really a stock. They're a stock that invests in real estate, but they still are a stock. So direct real estate means brick and mortar. And then TIPS, you could consider TIPS, which are Treasury inflation protected securities. They keep pace with inflation by adjusting the yield accordingly. Under recession or deflation, long-term government bonds. We talked briefly a second ago how bond yields or interest rates are inverse of bond prices. If you go in a recession, what's going on with interest rates? They're going down or actually negative in some cases, where we saw now we have the Fed funds rate targets at 0 to 0.25%. And during that time period, bonds have done extremely well. So we also see those in recession when stocks sell off, people fly to bonds, a flight to safety. So that typically is going to be your best safe haven asset class. Low inflationary growth is bull market equities, so any equity would go in there. U.S., international, emerging markets. But you could even throw in there things like high yield or junk bonds because they're highly correlated to equities, about 80-90% correlation to equities. So things that can consider that. But in this environment or kind of this framework, if you will, investing really becomes more simple, or at least diversification is. You have to own stocks for the good times, the low inflationary growth periods, right? That's the growth engine of your portfolio. But here's the key in rethinking risk, and what I want you folks to think about today is that we have to be aware of, acknowledge, and account for the two things that really derail that growth. That's inflation, which we haven't seen in some time, but I can pretty much guarantee you it's going to come back at some point, and recession or deflation, which we have seen a couple of bad recessions in the past 10 or 15 years that's killed the stock market. So those are the two things that derail the growth. But if you think about it, there's really a third risk. And that third risk is being out of the markets altogether, sitting in cash on the sidelines because of your bad experience in a recession like we had back in 08, 09, or back in the 73, 74 stock market crash during an inflationary time period. And you miss out on the bull market that happens after that, the recovery, because you've been completely out of the markets. You're scared to be back in the markets because of your bad experience in it. The point here is to be diversified and have a balanced exposure to different asset classes that are going to behave differently. So you always have something working for you. And the idea of this is commodities are very volatile. We've seen oil go from $100+ a barrel back in June of last year to below $40 a barrel back in August. So commodities are very volatile, but there are certain times of periods in economic eras that we saw that they're going to do well. And there's different things when bonds do well and they don't do well. And the idea here really is not to be solely dependent on an equity bull market because we don't know what it's going to be like when we're going to retire. That's the bottom line. So we have gone through a lot of things today. I want to give you guys time for questions. So I will go to here and we'll kind of summarize that, and I'll turn it over to Tori to see if you guys have any questions. So number one rule we learned is understand the market scoring system. We want to score our portfolios like the golfer, right? The magnitude, not the frequency. And then design your investment strategy according to that. Number two, don't market time. We can't figure out when the best days are going to be here, the worst days are going to be here, but seek to avoid those catastrophic losses. Remember, folks, that losses have that exponential impact to our returns versus gains. 50% loss requires 100% to get back to even. Bad times to try to get back up. Number three, the secret to building your wealth is maximize your contribution. Save, save, save. And the more you save, that's one thing you can control. The second thing you control is have a more conservative allocation. You don't have to be 100% invested in equities because you're not so reliant on the market, because the savings is doing a lot of the growth for you. Number four, be prepared for the unexpected. We just said that. We don't know when inflation is going to be here. We don't know when a recession is going to occur. In fact, we don't usually know until after the fact, after the revised GDP numbers several times afterwards. So be prepared, because we don't know when the market sell-off is going to come, and we don't know when bonds are going to do well, or stocks are going to do well, or when commodities are going to do well, or when real estate's going to do well. We don't have any idea, but it's a good idea to have some of those different things in your portfolio to offset those losses. And that's number five, is to invest by the sources of risk and have something that's going to do well in these various economic and market environments. And bottom line is that way, then you're in control more, and you're not solely reliant on a bull equity market to get you to retirement just in time for your retirement date. So that's the conclusion of my prepared comments. I will open up to Tori to see if there are any questions, and let you folks go to it.
Great. Thank you so much, Tracy. We will now start addressing some of the questions that have been filtering in. And please remember that if you have any questions during this time, you can submit them using the Q&A tool on the webinar menu. And as always, you can reach out to your dedicated service team, the ACEC-RT Financial Wellness Help Center at 844-ACEC-RT8, or you can email us at financialwellness@acecrt.com. Our first question: I am close to retirement, approximately 5 years away, but the equity investment does not settle well with me. Any guidance you would offer?
Well, without going on a limb here and offering advice, that's always a dangerous thing to do, especially over the phone and not knowing anybody's particulars, time horizon, how long you plan to retire, how much you have saved. What I would say is, at the very last kind of thing where it showed the three different kind of buckets you can look at, I would talk to a financial advisor or get some advice online to get some guidance to look at your particulars on time horizons and things like that. But the point of what I made is, you brought a good point home. As you said, equities don't sit well with me, I'm close to retirement. Well, close to retirement, you should not be in 100% equities, and certainly not in retirement, because we saw what could happen if you take a hit pre-retirement, right before you retire, or during retirement right off the bat, because it's hard to make those losses up. So what you want to do is make sure you own some different asset classes, different kinds of investments that are going to react differently. So if stocks sell off, you may have bonds to offset that. In fact, I did some research recently where the recent sell-off we had at the end of August, where we were in official correction, where the S&P 500 was down around 12%, long-term bonds were up about 7%. So there's a very classic, simple example of owning just something like a bonds to offset the losses of stocks, because while stocks are being down, you actually have a portion of your portfolio that's actually positive. And that's really where it comes into play. And I would really highly suggest, especially being close to retirement, to meet with somebody you trust as a financial advisor to kind of talk through and remember some of the things we talked about today and say, I want to be truly diversified. I want to make sure something's working for me while stocks aren't. And that's the best way to go about it.
Great. Thank you, Tracy. Our next question. Great presentation. Is the presentation recorded so that I can watch it later with my wife? I'll go ahead and answer this one for you, Tracy. So yes, all of our webinars on a monthly basis are recorded, and they are posted on the ACECRT YouTube channel, which is right here. So there's the link. You're welcome to copy and paste that. Everyone will also receive a webinar replay and thank you email that comes out between 1 to 2 weeks after this webinar is over. But the YouTube channel is a great resource to be able to rewatch and watch new webinars that maybe you weren't able to attend.
Great.
All right. It doesn't appear to. Oh, go ahead, Tracy.
No, I was just saying thank you for that feedback, and that's great. I didn't know we could actually watch that. So you can actually pull that up on YouTube, huh?
Yes.
Okay, good. Thank you.
Absolutely. Well, it doesn't appear we have any more questions at this time, but again, if questions arise, don't hesitate to call us or email us. And thank you again, Tracy, for your help today, and your presentation was really informative. Thank you, attendees, for your participation. I hope you all have a great day, and we look forward to seeing you at our next webinar. Take care.
And from Invesco, I thank you folks too. Have a great day. Bye-bye.